our floor show. And Key Advisors Wealth Management co-founder and CEO Eddie Ghabour. Eddie, so let's talk about this move in big tech right now, because big tech, of course, is in focus with these numbers. What are you expecting after the close?
You know, I think the biggest thing that the market is really focused on are a couple things. Number one is rate of change growth on the back end of this year, which is why I think you're seeing some software names take a bid after a year of struggling, and the semis are now having some concerns on that. The other is the CapEx numbers. The market is concerned with the ability to fund all this $1 trillion plus of CapEx that is the trajectory of estimations for next year. So this is why you've seen these big gyrations. At the end of the day, we are looking at the August and September, which we think is going to continue to be very choppy, probably more downside than upside, as an opportunity to rotate out of defensive positions and into these names that have taken 30 to 50% hits. Because we think when the dust settles post-Fed, the market's going to come to the realization that the fundamentals are strong, demand is strong, and the economy itself is going to accelerate. So we think this is really setting up nicely for being able to buy the dip incrementally into these areas that still have fantastic demand. So these short-term gyrations hopefully does not shake everyone out of their positions.
Well, I know that you've been going for cybersecurity and software stocks, but certainly if you do get a buying opportunity in some of these bigger names, I'm assuming that's attractive to you. But you mentioned the economy, you mentioned the Fed. I want to talk to you about not just the meeting yesterday, but we got a lot of data this morning. In particular, we got GDP for the second quarter. This was the first read, and it came in lighter than expected. And I was digging into the numbers and the reports to kind of see where we saw the changes here, especially from what the market was looking for. And imports rose, but that is because of the big AI spend, the data center spend that we're seeing. I also found kind of a bright shoot here, consumer spending jumping 3.2%. A lot of that, according to the government report, was because of tax returns. So Americans weren't shaken by higher gas prices that we've seen since the Iran war. They weren't concerned about tariffs, about supply issues. They spent, and that tells me that that's actually going to continue to boost the economy, especially if we get a pause in the escalation we're seeing right now in the Middle East.
We couldn't agree more. These folks that are worried about a recession, we don't see anything in the data that we're looking at that gives us any concern. The consumer's been extremely resilient. And to your point, we think by the time we get to the midterms that oil will be back into the low 70s, 60s, and that's going to be another tailwind for the consumer, which is why I'm concerned that the Fed is going to make a mistake and do some type of tightening in September. At the end of the day, a 25 or even 50 basis point rate hike is not going to get inflation down to 2%. And to try to slow the economy for the sake of trying to get to 2%, the damage is going to be much more than what the benefit would be. So I hope Warsh and their team members let the markets do their thing. I would argue the bond market is already doing the tightening for them. So if they just get out of the way, let the capital markets do the work, I think we'll be a home run for this year.
We had that discussion yesterday on the program, and I actually agree with you. I think that we are seeing the yields in the bond market doing the work. And maybe Kevin Warsh knows that, because he kept talking about that 2% target at the end of the day, but not pointing to any appetite for a hike. So we'll see what September brings. Eddie Ghabour, it's always great to have you on the program. Thank you for being with me.
Thank you.